All right, Good morning, everybody, and welcome inside today's trading room here at Finom Group. We got futures under a little bit of pressure here, off of the worst levels, at least for the Nasdaq and S&P. Dow futures a little bit heavy here. We got the economic data out this morning. Retail sales, as we had already known, because we get the vehicle sales for the month. The estimate of vehicle sales for the month already a couple weeks ago, and such a significant component within the Census Bureau's retail sales report. We understood that there was going to be, a pretty sharp bounce back in January retail sales. The other, reason that we have a big bounce back is because of the depressed reading in December's retail sales. Remember that December's retail sales were down 1.1%, so it was an easy comp. But as you can see, just, there's only one negative sign, and that's electronics and appliances, and that's on a year-over-year basis. Now, while the headline number is 3% monthly or month-over-month retail sales, much stronger on a year-over-year basis at 6.4%. And now I know most people are going to say, well, isn't that the inflation rate? Oh, so retail sales are only keeping up with inflation. Why is that a bad thing? People like to say these, off the cuff as if this is a problem, as if this is something you can control anyway. It's not. It's not a bad thing. Retail sales are really just getting back to trend. Remember last year in the first half of the year, we were growing retail sales still at double-digit clips. Even into the fourth quarter, we were growing sales at high single digits. We're normalizing retail sales on a year-over-year. And yes, price is a component to it. I mean, most of this is goods. We're talking about goods, services to a lesser extent within food and drinking places, restaurants, if you will. But still, we know goods prices have come down. We know inflation is coming down. Yeah, that's a factor in here, but it's not the override. The big picture takeaway from today's retail sales is that the consumer is still very healthy. Consumer still, we knew that based on what we saw in reported motor vehicle sales 2 weeks ago. But we also knew that based on what we saw out of Bank of America's card spending data. We got just the prior week. There was a big jump in the reported card spending data by Bank of America. Why Bank of America? Why not JP Morgan Chase? Why not Wells Fargo? Because Bank of America has the largest account number, the number of accounts of Americans here. So, as Bank of America card spending data goes, usually retail sales have a very close correlation or relationship. So there was good reason to believe you'd have this bounce back. A couple of key categories that I often highlight and like to look at are the non-store retailers, which is e-commerce, and department stores. And the reason why I like to look at these is because department stores suck. I mean, they've been on a 10-year, a decade-long downtrend because, the business is being siphoned out of brick and mortar, out of department store sales to e-commerce, right? I mean, Amazon isn't growing just because. It's getting its share of total addressable market for retail sales is growing year after year after year after year. There's been some hiccups in this post-pandemic period, obviously, but looking at seasonal factors here in the January period, people are, wow, look at 17.5% department store sales on a month-over-month basis. And this is not what you see usually. Usually there's a negative sign behind both the month-over-month and year-over-year. I mean, these are big outsized numbers, but from a seasonal perspective, this is accurate. Why? Well, think about it. December, you get your gift cards, right? You get your holiday gift cards. You're gifted these items, and when do you spend them? You spend them after the holidays. You spend them in the new year. So it's actually bringing people to the stores with those gift cards. Well, when that happens, naturally, you're going to have this step back function in non-store retailers. Now, the month over month is typical. This is not bad at all, but the year over year is. That's where you can see the seasonality. Usually, this is in the 8 on any other month. This is between 8 and 11% year-over-year growth, but it's only 3% here. Again, that's a function of January, the January seasonal effect taking business out of e-commerce because folks have the gift cards. They spend the gift cards at physical department stores. We done here? All right, we're done here. Let's close up shop there. Look at futures once again here. Now they're getting worse again. Now, after the economic data came out, and by the way, Empire State Manufacturing reading also came out, big bounce there. I mean, it was like down negative 32 in the, I guess it was the December reading. And it's now only down, it's still down, but a big bounce off those lows. I think it was down only -5. So a big bounce off those lows, which is consistent with what we're seeing out of both Europe and China, right? Since the China reopening, we've seen a big jump in the cakes and PMI, which is their manufacturing index, jumping into positive territory, or a number above 50. 50 separates expansion from contraction. Anything below 50 in a manufacturing reading is contraction. Anything above 50 is expansion, and the cakes and PMI jumped slightly above 50 in the latest reading. And that's giving, when China reopens, the biggest trading partner for Germany, for the Eurozone, is China. We've seen a jump in the regional Eurozone PMIs as well. And normally, or historically, since China has become the super manufacturing powerhouse that it has over the last 30 years, we see the same positive feedback loop in United States or North American PMIs as well. We just hit the lows in December across all regional PMIs, as well as the ISM manufacturing index. This early reading out of the Empire State Manufacturing Index today might be the green shoots of a trough, the bottoming, the official bottoming in regional as well as the ISM manufacturing, S&P Global Manufacturing Index as well. Don't want to leave that one out. Tomorrow we'll get more indications out of the Philly Fed Manufacturing Index. A lot of economic data tomorrow to digest as well. Tomorrow we have the Producer Price Index, as well as housing starts and building permits. And of course, it's Thursday, so jobless claims. All right, bond treasury market here this morning. Now, after the data, we've seen a lot of gyration, fluctuation in treasury yields. We had been as high as 3 basis points higher today on the 2-year. The 10-year is close to its high, but we went down. We've been down after the economic data this morning at the long end of the curve, and now they're elevating again. And as we are seeing them elevate again, we're seeing futures edge lower. That relationship has been pretty tight until the open market equity session. Even yesterday we saw bond yields tick nicely higher. I mean, we were up 9 basis points on the 2-year yield yesterday. The 10-year yield was up about 5 basis points. And yet the NASDAQ, growth, tech, those were the leaders yesterday. The S&P 500 barely down 1 point on the trading session. That is not what we've seen with large moves in treasury yields. Bonds were sold yesterday, yields went higher. Bond prices go down, yields go up. It's that inverse relationship. And usually when we've seen yields go up to the extent they did yesterday, the market had an inverse step down as well. Throughout all of 2022, that was the case. Bond yields have a big move to the upside. Equities, excuse me. And this is why we're not going to have a state of the market video this week, and we're doing kind of a inside look at our trading room operations every day here at Finom Group, because I'm still trying to get over this cold, still coughing, my voice is still rough, although much better. So no state of the market this week. Anyways, ever since the first rate hike last year, when we saw big moves in treasury yields, we saw equities go down. I mean, on some days, 2+%, most of the time, 1%. But that didn't happen yesterday. And I want to reinforce the dynamic change, the character change in markets here this year, and pretty much since day one of the new trading year. right? Every dip has been bought, completely opposite of what we had last year. Last year, every rip was sold and everybody was in deleveraging function. When you get higher prices, you sell into that. It's completely different this year. This year, when we get higher prices, we're getting even higher prices. And when we get, some kind of consolidation, it's getting bought up quickly. Last year, we would go up for a couple days, even a week, and we'd lose it all in a single day. This year, again, complete opposite. This year, we consolidate for a couple days, we gain it all back in one trading day. Very big change here in the character of the market. There's a message from the market since the beginning of the year, and I think the message had continued yesterday. So what does it mean when the market, when equities are not derating, when they're not devaluing as treasury yields are going higher? First thing I would say is it was just one day. So we don't want to draw any conclusions. We don't want to be definitive and say, this is what it means. But, if we are to assume and have kind of a working hypothesis, we can suggest that it's in keeping with the overall market message this year. And that is, these rate hikes are not producing a commensurate derating of equities. Maybe they've already de-risked to the extent that they are rationalizing the earnings outlook going forward. They may even be saying this decoupling of that relationship between treasury yields and equity de-risking may even be saying, analysts, you took your expectations down too much, right? Because the market, the equity market, just like the bond market, is a forward discounting mechanism. What are they discounting? Well, they're discounting earnings out into the future. We dropped 25% on a closing basis last year, but earnings were actually higher on a year-over-year basis. The market was discounting less growth in earnings, even the possibility of an earnings decline in 2023 on a year-over-year basis. But what if that doesn't materialize? Think about the economic data we've already gotten here through January and early February, or the first 2 weeks of February. By the way, happy Valentine's Day, belated or otherwise. What if that earnings outlook that was being priced last year doesn't materialize? What if earnings are flat? What if earnings are actually still up slightly? The economic data is not consistent with an earnings decline on a year-over-year basis. It's just not. Retail sales growing this much, still 6+% year-over-year, is not consistent with an earnings decline year-over-year. In about 4 minutes, we're going to get the industrial production, which is also expected. Economists' estimates show a bounce back in industrial production. We've been, I think, on a 2-month decline in industrial production, off record highs. I emphasize that because you usually don't get a recession when industrial production is at record highs. So the magnitude of the bounce back will be, important to see how much, if we recapture the new highs, or, it's significant enough to, ward off those recessionary fears once again. But that's the other thing that has changed over the last couple of weeks as well. Everybody was forecasting a hard landing, an inevitable recession last year. The yield curve's inverted now at the deepest level since 1980 or 1981, forgive me. Right? Got to have a recession. Campbell Harvey, who did his thesis on yield curve inversions back in the 1980s, he came out earlier this year saying, I know 8 of the last 8 recessions have been signaled by a yield curve inversion prior to the recession. But I think this one is not going to be the predictor of the recession this time. And yet people are still touting, or had been, still touting a hard landing, an inevitable recession into year-end 2022. They thought we would have one in the fourth quarter, if not the first quarter of the new year. And as we transitioned into 2023, the debate started elevating that there was a higher probability of a soft landing, as the economic data didn't seem so bad. Now we're not just talking about the possibility of a soft landing, but as the economic data continues to come out better than expected, right? The Citi Economic Surprise Index back in positive territory, meaning the economists had been underestimating the strength of economic data or economic activity in the first quarter. There's now the rumblings of no landing whatsoever. Hard landing, soft landing, no landing. We're literally talking about no landing, i.e. no recession. It's amazing how prisoner of the moment market participants can become depending on the ebbs and flows of the economic data. But that's what it is. It's sentiment. These predictions are sentiment. As the S&P 500 fell further and further through the course of 2022, the hard landing, drum beats kept elevating. They kept rising and rising and rising and rising. As the S&P 500 price has shifted in 2023, the hard landing drumbeat has faded. The soft landing drumbeat has elevated. Now we've got this new drumbeat. The chorus has changed. All right, futures still, digesting all this data. Again, we'll get the industrial production here. Should be out right about. Come on. Come on. Any second now. See what bond yields are probably rising, and they are. 2 years come back in, and the 10 years stable. I mean, everything's positive, so we'll see. And usually things do change once the equity market opens. You see this, once fund flows for equity start, you see some type of, movement in the treasury market as well. Looking for industrial production. There we go. 0. That's not good. Well, it's less than expected. Less than expected, right? Because they were looking for, a 0.5 increase. It is flat as opposed to the 0.4 decline, I think, the previous, 0.7 decline the previous month. So, it is a bounce. It's not as strong a bounce as expected by economists. Bounce nonetheless. All right. With the economic data out of the way here today, again, tomorrow's economic data, jobless claims, housing starts and building permits, and of course, the last inflation data point or flashpoint of the week, the producer price index. Any questions in the chat box, crew? Any charts you guys want me to go over? I always, I like to look at my performance ratios, pretty much every morning, if not every other morning. Here's one that I was looking at this morning for those of you who also follow me on Twitter. Now, we've been following this chart. This is the relative performance ratio of the transports versus the utilities. You could also think of this as economically sensitive versus defensive. Cyclical versus defensive. Usually what you want to see, if you're bullish, if you're pro-growth economy, you want to see transports outperforming utilities. If that's the case, we're usually in an expansion cycle. Investors are bullish. Investors are risk on as opposed to defensive, i.e. risk off. One is we hit long uptrend. This goes all the way back to 2008. Obviously, long-term uptrend consistent with that longest expansion cycle in history. And, we started this downturn that was COVID related, obviously, and new cycle began. But in 2022, bear market, fears of a recession, the Fed hiking, everybody got defensive. Utilities outperform transports. When the trend line is moving downward, Transports are underperforming utilities. Utilities are outperforming transports. But here, towards the, I guess you could say, late 2022, we saw a reversal where transports were once again outperforming utilities. Risk on, cyclicals over defensives. And that has been the trend here this year as well. We'll narrow it down to a one-year chart in just a minute. What I want to point out here, though, is the rate of change in the bottom panel. And what the rate of change helps to inform from a historical perspective is, man alive, look at the size of the rate of change here. Right? That was a big move in this relative performance ratio. The biggest move of the cycle, the biggest move since the 2020 bear market, or the COVID bear market, if you will. Somebody got their mic on. Okay, got you, Peter. So, and again, this is comparing different cycles, history, if you will. Whenever we see the rate of change get this high, look at that. It coincided with the bottom in the relative performance ratio, coincided with the bottom. If not exactly, within the same time span, a couple months, 3-4 months, usually the market had bottomed as well as the economic conditions bottoming. Big rate of change here, COVID bottom. Big rate of change here in 2016. We remember we had a significant correction from late 2015 into the first quarter of 2016. There was also a presidential election year. Big rate of change. That proved to be the bottom. In 2017, for those of you who know your market history, what happened to the S&P 500? Did nothing but go higher. In fact, it was the biggest drawdown in 2017 was, I think, 2.5%. That also ended the manufacturing recession. Early 2016 ended the manufacturing recession. And yes, you can have a manufacturing recession without having a broad scale economic recession, obviously. Here again, not quite as high, but usually bottoming. Early 2009, folks, 2008, 2009, here you are, right there. That was the bottom in the performance ratio, big spike in the rate of change. And we all know our market history. In the first quarter of 2009, that marked the bear market bottom. And so using the rate of change stochastic, we can possibly lay claim to the market bottom having been in for this particular cycle late last year. It's been risk on. It's been cyclicals over defensives all 2023 so far to date, even though it's a small sample size since we're only in the nascent part of the new year. Narrow this down to 1 year so we can look at the more closely. And folks, we're hovering at the highs now in this performance ratio. Haven't quite gotten back to April of last year's level. Does this scream economic recession? Right? Why in the world would transports be doing this well compared to utilities if there was real fear of a recession near term? Things can change quickly. I get that argument. I know. I've heard it all before. It's funny. The bears like to point that out. As they kind of assuage themselves of the, price is truth. The trend is your friend. They kind of forget those disciplines. Most technicians are bearish. Most technicians are looking for problems. And when they can't find a problem here, they'll assuage it in some other way using colloquialisms. All right. Any other performance ratios we want to look at? There's a ton of them. And another one of my favorites is the Qs versus SPYs, growth versus value. The Qs representative of, the NASDAQ 100 ETF, if you will. informed that, I mean, that's a growth index. The NASDAQ is a growth index. S&P 500 index ETF or SPY, it's more of a value index. Not complete. There's tons of growth stocks, but compared to the NASDAQ one, no, it's not quite as concentrated with growth. I'll take the rate of change off of there. Don't really need that for this one, or that's not my focus for this performance ratio. So how has growth done relative to value? If we're looking at it from an index ETF perspective, same thing. Late 2023, this bottomed and has been in an uptrend ever since. Right? The NASDAQ, I think at its peak here this year was up 16% year to date. I think at its peak year to date, the S&P 500 was up 8 or 9%. So clearly huge outperformance. Opposite of last year. What worked last year isn't working this year. What didn't work last year is working this year. But this is a huge move in a relatively short period of time. We can look at value versus growth ETFs as well from Vanguard. Vanguard Value ETF relative to the Vanguard Growth ETF. So if value is outperforming, the trend line is going up. If value is underperforming, trend line's going down. And what do we see? Trend line's going down. Value is underperforming growth. Now, keep in mind, the drumbeat, even this year, regardless of the performance in the indexes, in growth versus value year to date, they're still beating the drum. We prefer value over growth. We're in a new cycle. Inflation, we believe that the next decade will favor value over growth. They're still saying that despite what we've seen year to date so far. And maybe they'll be right. Maybe this is just a brief period where you get this outperformance and growth, just kind of normalizing things over a longer time period. I'm doubtful of that. Why? Because we still have to respect the composition of markets. We have to respect the composition of ETFs. What's the biggest component, if not the bigger component, of a value fund, of value in general? It's energy. It's energy, folks. So you have to believe that, yes, last year's dramatic outperformance in the energy complex will be repeated, if not just again, carry that outperformance here in 2023. 2 years of outperformance in energy. Good friggin' luck with that. That is something you rarely see, and I don't know that we've seen it since either the 1980s or 1970s. Like, if that's your thesis, man, are you going against history? Nonetheless, that is still the drumbeat. And here's the other problem I have with that thesis. Last year, I mean, we knew energy had huge, I think energy sector grew earnings like 50, 60%. But this is 2023's projected complete year, CY complete year. If you favor FY full year, good on you. Complete year 2023 projected earnings by sector. Look at energy. Remember, they grew 50 to 60% earnings growth last year. No wonder energy had the performance it did last year. No wonder value outperformed growth to the extent that it did last year. But this year, look at the estimates. For the full year, energy expected to decline 16%. It's flipped. Last year, consumer discretionary was in the red. They declined, I think, 10 to 12% EPS. But it's expected to grow 28 plus percent this year. Again, these are just estimates. They'll change every single month of every single year, and especially during earnings season. But they're not going to change dramatically, from what you see here, in my opinion. Up or down, they're probably going to hold. Discretionary up, energy down. So not only if you're in the value trade, if you're in the commodities trade, the energy trade, Do you have to believe that they're going to have 2 years of outperformance? But you have to believe, despite earnings declines, they're going to go up. And here's the other question I had. The bears are promoting the value trade. The bears are promoting the commodities, the energy trade, despite this fact. And why do I say I mean, the bear, the market bears. They keep saying, well, earnings are expected to decline year over year for the S&P 500. Why should we be bullish? We're staying bearish. Well, if that goes for the market as a whole, why is that not going for energy? Why is that not going for value? They run themselves into this brick wall argument of nonsensical articulations. You can always catch a bear, because it's just not a good idea to be bearish long term, that's for sure. But their arguments for the market aren't matching their bullishness for energy or value. It makes no sense. Futures now, worst levels of the session again, for the NASDAQ, for the S&P. We made lower lows here on S&P 500 futures. Barely positive here. We got a minute until the market opens. I will drop the mic. Thank you for joining us here in the trading room. Hope you enjoy. If you're not a subscriber to Finom Group, we do this throughout the day here in the trading room. Trade alerts, investment ideas as the market opens and as we trade through the course of the session. Have a great day, everybody.